So allow me to briefly touch on the top three things from Keith's macro notebook today. So number one, Asia. It's not a headline story yet, but the Keith's model is signaling multiple breakdowns across a lot of these Eastern stock markets. So Indonesia broke a few weeks ago. India's breaking down, and that's confirmed overnight with another 2.3% drop. And then obviously Australia cut rates the other day, and their stock markets has dropped 2.3%. And that's as commodities are going up, and commodity currencies, including the Aussie dollar, are going up. So again, and then obviously you have the Shanghai Composite that's down 5.6% in 2 days. They're just running out of stimulus rumors. I mean, you can't come out with a rate cut or a triple R cut every day, or at least they have not thus far. And that's causing some consternation in that market, along with some speculation around tighter security or tighter lending practices within stock market margin debt. Number two, oil. So it's the perfect study for a bear market bounce. So you have a 6-month crash, then you have a rally, and then obviously with the rally and the dollar pulling back here, the correlations are tightening. And so now we're seeing intermediate term lower highs and with higher lows. That's a very difficult market to risk manage. You obviously pull both sides of the positions at some of these critical pain points in the markets, and that's something we expect to continue, at least for now. Number three, the Russell obviously does not like down dollar. So if you overlay a chart of the Russell with the US dollar over the last 4 to 6 weeks, you get what we're saying. So as long as the dollar continues to go down and oil continues to go up, you're essentially taking away the domestic economy's consumption tax cut that was very positive for 3% year-over-year GDP in the first quarter. Obviously the sequential number was kind of a disaster, but on a year-over-year basis, that's the fastest rate of growth we've seen since the fourth quarter of 2013. So you almost got 2 years or sort of 6 quarters of really good growth there, or the best growth rate rather in 6 quarters. So definitely something to keep in mind, that if we're continuing to be wrong on oil, the probability that we're going to be right on growth slowing from here is very high. Now we'd have to shift our views on inflation and start to allocate more to inflation assets, things like tips, gold. But that's not something we're making the call on yet, but you can follow the bouncing ball in our process there. That's essentially, if you think about our GIP model, our growth inflation policy model, that's essentially moving from quad 4, which is a situation where growth is slowing and inflation slowing, to quad 3, which is a situation where growth is slowing as inflation is accelerating.